Does it take to live off dividend stocks to the point where dividend payments cover all of the expenses you would want it to cover and more? In this video, we're going to talk about how people build up with dividend investing and successfully retire through these investments. If you want more videos like this one, make sure you subscribe. We talk about stocks and investing here very often. So one thing to know about dividend stocks is the way you figure out what you need in the moment is you say, I had this much expenses that I pay in a given year, and you have an average yield that you go after for a dividend stock. We'll use 3% in this example. And then you figure out how much money you need to have at 3% yield to pay off your expenses. So the first thing here isn't about picking the right stocks. It's about knowing your current financial situation. So let's say for this example that you spend $60,000 each year. This accounts for your living expenses, your car payments, your food, every single expense. Let's say it adds up to $60,000 each year, and you are targeting an average 3% dividend yield. The reason some people target something like a 3% yield rather than something super high like a 6 or a 7% yield is that usually with 3% yields, you have stocks that still have a lot of appreciation potential, and they are likely to raise their dividends significantly over the course of several years. AT&T is usually the golden child when it comes to income investors, where they just look at the yield, but you're not going to get rapid appreciation with AT&T stock, and they only raise their dividend by 1 cent per quarter, which, I mean, 1 cent, like that's their quarterly payment increase per year. So for instance, if AT&T is paying 52 cents per share per quarter, that adds up to $2.04 per year. You'll likely see them raise that to $2.08 per year or 53 cents per quarter. So you're seeing very minimal growth at AT&T. It's enough growth to have the extra boost, but it's not going to be something monumental. So some people shift to the 3% because they want the stock price appreciation and they want the dividend growth as well. One stock that I really like, especially at current prices, is Prudential, which actually has close to a 6% yield just because of the big drop because of the whole pandemic. And the stock's been climbing up back to its pre-pandemic levels, but that has resulted in a very juicy dividend yield that will not be like that within a year because everything will eventually recover. So that's a stock where it's not always at the 6% yield that it's at now, but if you do look at its dividend history, you could do this by searching the ticker symbol of the stock and then just put dividend history. You'll get to some NASDAQ page, and you can see for this stock, it's almost doubled its dividend within the past 5 years. So one of the things that people just do is they'll just look at their expenses, so $60,000 a year. They'll look at the yield. They're targeting 3%. You divide you do 60,000 divided by 3%, you get 2 million. So you would need $2 million at a 3% yield in order to bring in $60,000 each year. But if you go back to the Prudential case where their dividend almost doubled within 5 years, you wouldn't have needed 2 million to achieve that goal within 5 years. If you had $1 million in that stock and then it doubled its dividend payments, then you would achieve that goal as well. You could also get into a stock where the yield is a little bit higher than 3%, like in Prudential's case, where it's definitely much higher, but have an idea of what you're going after with your dividend stocks. Now, retirement from dividend investing is a decade longer, usually more than that for most people, process, because it's based on how much money you put into the system. Because you could do all the research, you could find out which stocks give you the best dividends, give you the best growth, hit all of your check marks for your criteria. But the only way those stocks produce the dividend payments is if you have enough shares to hit your goals. So that's where you have to put money into all these different stocks each month and really pay attention to which stocks have been beat up recently. Dividend investors, it's kind of weird because if the stock appreciates, you're happy because you increase your net worth. If the stock depreciates, you're also happy for some reason, because then that means you get to buy more shares at a lower price. It's basically buying the dips. So pretty much it's win-win-win regardless of the direction the stock price goes. If the stock goes up, appreciation, but it takes more money to buy more shares. If there's depreciation, you get to buy more shares. But if you pay attention to multiple stocks, you can see which ones depreciated far more than they should have and buy into those companies for a higher yield. Yield isn't based on what you hear in the news. Yield is based on what price you buy it at. So if a stock gives you $3 per year in dividend and you bought it at $100 a share on average, you have a 3% yield. Even if the stock goes up to $200 and the dividend's at $3 per year, that would be a 1.5% yield. But since you got it at $100 a share, it's a 3% yield for you. So there's the difference between the current yield and there's a difference of what yield you're actually getting based on what you paid for the stock. Now, the great thing about dividend investing is that it compounds over time. So as with Prudential, they've almost doubled their dividend within 5 years. And that's not just doubling the dividend based on what Prudential decides to do, but it's also based on what you decide to do. So you could reinvest the dividend. So instead of taking the cash, you could put it into more stock. So I'm currently at a position right now where I get 2 new Prudential shares roughly per quarter. And again, that's based on current price, that's based on dividend. That's all subject to change based on how much they raise the dividend, how many shares I add to my portfolio, and what the stock price does. So because of this position, then the following dividend payment, I'm going to make an extra $2.20 because they currently do $1.10 per quarter. And $2.20 per quarter extra, it's not a lot. Like, people don't think of that as much. Like, think about what $2.20 buys you, not too much, but it is the compounding over time. And you combine that with dividend increases. And if you hold on to a stock that grows its dividend nicely in the course of 10 years, you could get to your retirement goal a lot faster. So instead of thinking about it, again, just as the yield and your expenses and doing that division to figure out the math, think also about the dividend increases. And if you look at the history of a stock's dividend, you can see how much they increase the dividend each year and just get an average estimate. So maybe based on the past 5 years, the stock increases on average 10% a year, 20% a year, which would be very high and very good if the company could afford that. Or it increases at a more reasonable 5% each year, which you do see that type of dividend growth in a lot of companies. One of the things to think about as you invest in dividend stocks is that this money just doesn't come through thin air. Like, the company, they allocate some of their earnings and they say, okay, we don't know what to do with this money. Let's just give it to our shareholders. So if they're doing that with 100% of their earnings, that dividend is very unsustainable. On the other hand, if they're doing that with roughly 50% of their earnings, then the dividend's more sustainable and there's a lot room for the dividend growth to occur. That I was just talking about, that's just the payout ratio. So if you want to look up dividend payout ratio for each of your individual stocks before buying, just to get an idea of if the dividend is sustainable and if they could grow it in a meaningful way each year, then that's going to put you in a better position to retire through dividend investing. Now, one of the things about retirement, though, is that I don't think people should fully retire. I think you always got to have some work to do. So the way I see dividend investing for myself is just a flexibility choice where as I build up the dividend even more, I could choose what I want to do. I could choose what I don't want to do. And I have this choice already, but it's just money isn't as much of a sway factor as it is now, especially when you are in your 20s and you're trying to build up, or especially when you have a family and you got to pay all the expenses. But you get to a point with dividend investing where maybe you don't do the 9 to 5 anymore and you do something remote part-time, and that makes enough money to pay off expenses. It's like how entrepreneurs, they pursue a side hustle that eventually becomes their main hustle. But how do I pay off all expenses in between? And that's where something like dividend investing can come in as a short-term umbrella while giving you the time to build up your side hustle. Now, one of the big issues with dividend investing is that unless you're picking a stock that has very minimal dividend yields, so Apple, MasterCard, like these companies have dividend yields less than 1%. It's going to take forever to retire off of those. And yes, they do have dividend growth, but it's going to take considerable time just for them to reach a 3% yield based on the price you purchased them at. So that's one concern. Another concern is that a lot of the stocks that offer dividends, they are a little bit more mature. You don't usually see these eye-popping numbers with any of these stocks. Like Amazon, they don't offer a dividend because the key to offering a dividend is, well, we don't know what to do with this money. So here you go, shareholders. Thanks for supporting us. Like if you have a lot of growth opportunities and catalysts, you're going to keep investing into your company. You're not going to have a spare dime left to give to all those shareholders. So that's why a lot of the stocks that don't offer dividends, they have these higher growth rates. Like any article that's like, oh, if you bought Amazon 10 years ago, if you bought Netflix 10 years ago, or Google 10 years ago, or Facebook 10 years ago, or Apple 10 years ago, Apple has a dividend, but it's very small. And I know I just pretty much said all the FANG stocks right there. But if you look at those types of trajectories, you don't see that as often, if at all, with dividend stocks that are on this more mature trajectory where it's more about stability and slight growth rather than these eye-popping numbers. So one thing you could do to build up the dividend investing, but at the same time build up on the growth because you don't want to miss out on those opportunities, is allocate some of your money to growth investing and allocate some of your money to dividend investing. I don't think people have to embrace one set of investing criteria, like choose one different investing asset. It would be like people going all in on stocks, going all in on real estate, while you could just do a little bit of both instead. So if you do have some of those growth stocks that do accelerate and hit those incredible numbers, you can decide later on, oh, maybe based on where I am, I feel like I want more dividend income. I could shuffle some of the growth stocks into dividend investments instead. So I increase my income. But with a growth stock, you get those higher capital gains, which just means more money you could put into dividend stocks. One of the strategies you can use also with growth stocks is to sell long-term far out of the money puts. So I did this with Roku. Actually, I sold a put at the 210 strike price expiring in January 2022. Basically what this means is that if Roku goes to below $210 per share and it stays like that by January 2022, I am obligated to buy 100 shares of the company at $210 per share. If the company goes up to like $300, I don't get the shares, but I get the premium, which I'll talk about later. If the company goes down to $150 a share, I'm still obligated to buy at $210 per share. I believe in the long-term vision of Roku, which is part of the reason why I decided to sell this put on it. Now, because it's such a far out put, a premium it increases in value if your strike price, the price you agree to buy or sell at, is closer to the actual price, and if there's a lot of time from today to the expiration date. So I got a little over $4,000 in premium through this transaction, and that was $4,000 I was able to put into dividend stocks. Now, in case you're wondering, well, why don't you just take the money from the cash secured put and just put that into dividend stocks instead? If you look at the $210 strike price, $21,000 for a cash secured put, and you're getting $4,000 out of that, that's more than what you're ever going to make in a single year as a dividend investor, just from a yield standpoint. So now you have this extra money you can put into your dividend stocks. And if Roku were to go up to $300, the put expires worthless, and then I get access to all the money that's in that cash secured put right now. That's additional money on top of the just bonus $4,000 plus from the premium that I'm now able to put into either dividend stocks, or I do another cash secured put for a different company, or I just spend some of that on growth stocks. So selling cash secured puts that are far out with expiration with growth companies you believe in can net you a really good yield. It gives you extra money to put into other companies. And rather than buying the 100 shares up front, you have the benefit where if it goes down in price, you're getting it at a slight discount because I always set my strike price a little lower than the current stock price. And you did get that extra premium that you could immediately deploy into dividend stocks. So those are just some of the different approaches. I think any person into dividend investing should also look at selling options. It's a great way to complement the dividend income that you want to make. But dividend investing, it's just the best way to retire because you don't really have to do much work to maintain it. You just do some research in the evening or in the morning. I like to do my research in the evening, and you just make sure that your stocks are still humming and they're keep on raising the dividend and they keep on paying. And then you are set to go. Real estate is a little bit more active to maintain all of that cash flow. But it's just a little bit of a breakdown of how to retire through dividend investing. It's all about knowing your numbers, putting more into dividend stocks each month, and letting the compounding take its course. If you are into dividend investing, I'd love to hear from you in the comments, or if you are into growth investing and you're more of the capital gains game. On any event, I always love to hear from you guys in the comments. Subscribe if you want more like this, and I will see you guys next time.